Vistra Corp., the largest competitive power generator in the United States, operating 44,000 megawatts of gas, nuclear, and renewable capacity across 7 electricity markets, serving 5 million retail customers.
VST generated $17.7 billion in FY 2025 revenue, with $5.9 billion in adjusted EBITDA, powered by nuclear expansion, AI data center contracts, and Texas retail electricity scale.
The story begins in 2016. Vistra Energy emerged from the Energy Future Holdings bankruptcy, combining Luminant Power Generation and TXU Energy Retail into one independent competitive power producer.
The 2018 Dynegy merger doubled Vistra's footprint. The 2024 Energy Harbor acquisition added 4,000 megawatts of nuclear, making Vistra the second largest nuclear fleet in the U.S.
Meta signed 20-year nuclear PPAs for 2,600 megawatts in 2026, the largest corporate nuclear supply commitment in history. Amazon has a long-term deal at Comanche Peak in Texas.
Wholesale power sales across ERCOT, PJM, and MISO contribute 60% of revenue. Retail electricity, sold through TXU Energy to 5 million customers, accounts for the remaining 40%.
Vistra's primary profitability metric is adjusted EBITDA, because electricity is a commodity business with mark-to-market hedging. FY 2025 ongoing operations EBITDA reached $5.9 billion.
FY 2025 GAAP net income fell to $944 million on unrealized hedge losses, a non-cash accounting item. Ongoing EBITDA rose 5% to $5.9 billion year over year.
Q1 2026 delivered adjusted EBITDA of $1.5 billion, EPS of 131 beat 128. FY 2026 ADJ EBITDA guidance of $6.8 to $7.6 billion reaffirmed.
Constellation Energy is the primary competitor, the largest nuclear fleet in the U.S., similarly positioned for AI data center power contracts. Vistra's Texas nuclear anchor and 5 million retail customers differentiate it.
NRG Energy is the retail peer with no nuclear. Talon Energy set the AWS nuclear PPA precedent in 2024, but operates a much smaller fleet. Vistra combines retail scale with nuclear baseload.
Vistra's moat is Vistra Vision, the subsidiary holding all nuclear assets and power contracts. No other competitor combines 44,000 megawatts of capacity with 5 million retail customers.
Vistra's primary market is Texas. TXU Energy serves approximately 2.5 million retail customers in ERCOT, anchored by the Comanche Peak nuclear plant under Amazon's long-term power agreement.
In the East, Energy Harbor's nuclear fleet, Perry, Beaver Valley, and Davis-Besse, holds the Meta 20-year contracts. Cogentrix, pending close, adds 5,500 megawatts across PJM, ISO NE, and ERCOT.
Jim Burke has led Vistra since August 2022, guiding the company's pivot from a Texas retail electricity business toward the dominant AI-era nuclear power platform in competitive U.S. electricity markets.
Burke holds a 2-lane economics and MBA degree, is a licensed CPA and CFA charter holder, and completed MIT's nuclear reactor technology course. He joined TXU Energy in 2004 after serving as president of Gexa Energy.
Vistra, the competitive power generator, $17.7 billion in FY 2025 revenue, with nuclear capacity and AI data center PPAs as the compounding growth layers beyond retail electricity.
Q1 2026 delivered record ADJ EBITDA of $1.5 billion, EPS of 131-128 estimated. Full-year ADJ EBITDA guidance of $6.8 to $7.6 billion reaffirmed.
Vistra Corp just reported Q1 2026. Revenue $5.6 billion, up 9%. Operating income $1.5 billion. 3 catalysts landed in the same quarter. Meta PPA, Cogentrix acquisition, Fitch upgrade. America's largest competitive power generator is now contracted to supply AI data centers. This is Charged Alpha.
And I am Lana, ticker VST, nuclear baseload, Texas gas fleet, and a new contract with Meta. Vistra is the power infrastructure play on the AI supercycle.
The Q1 2026 snapshot. Revenue of $5.640 billion, up 9.1% year over year. Operating income $1.499 billion. Operating margin 26.6%. Net income $980 million. Stock at $145 off the 52-week high of $193.50. Consensus analysts target 165, about 14% upside from here.
On EPS, Vistra reports two metrics. GAAP diluted EPS is approximately 280, estimated from 980 million in net income over roughly 350 million diluted shares. The FMP field shows 0, a data artifact from preferred share adjustments. The Street tracks ongoing operations EPS pegged at approximately 320, a non-GAAP company metric. On that basis, the quarter is a slight miss. Revenue was a beat. Consensus expected roughly 5.2 billion. Vistra delivered 5.6.
The Meta PPA is the Q1 2026 milestone. Vistra signed a long-duration power purchase agreement to supply electricity from its fleet directly to Meta's AI data center infrastructure. This is contracted demand locked in before a kilowatt is generated, revenue that does not fluctuate with daily spot power prices. That shift from merchant generator to contracted power supplier is the core of the VST re-rating thesis.
The Cogentrix acquisition is the operational complement. Vistra added Cogentrix Energy's natural gas fleet, expanding dispatchable capacity. Nuclear plants like Comanche Peak provide baseload, constant output, no ramping. Gas fills the lullowing role when demand spikes. Nuclear plus gas is the exact combination hyperscalers require for 24/7 reliability. Cogentrix closes the gap that nuclear alone could not cover.
The Fitch upgrade is the third Q1 catalyst. A credit upgrade for a competitive generator with $12 billion in debt is not routine. Fitch cited improved cash flow visibility from the PPA strategy directly. The upgrade lowers borrowing costs, reduces refinancing risk, and signals institutional confidence in the balance sheet trajectory. With $600 million in annual interest expense, even a modest rate improvement compounds significantly over the debt maturity schedule.
Operating margins confirm the fleet is executing. The 26.6% margin on $5.6 billion in revenue reflects strong power price realization across ERCOT and PJM. Q2 and Q3 are seasonally critical. Texas summer drives electricity demand and prices to annual peaks. The five-quarter revenue trend: Q1 2025 $5.2 billion, Q2 6.8, Q3 7.4, Q4 5.0, Q1 2026 5.6. Summer-heavy earnings profile, and the summer is ahead.
EPS over those same quarters: 210, 580, 620, 190, now 280. The full-year consensus of 1850 implies sharp summer acceleration. The structural transformation story matters more than any single quarter's metrics.
Revenue beat consensus by approximately 8%, $5.6 billion against the $5.2 billion estimate. Each PPA signed and each acquisition completed reduces Vistra's exposure to spot market volatility and deepens the contracted revenue layer that long-duration institutional investors need to own this name at scale.
The bull case starts with a macro constraint that is becoming undeniable. The United States grid does not have enough reliable electricity for the AI build-out. Data center electricity demand is growing 15 to 20% annually and is accelerating. The grid, built for a world of slow, predictable demand growth, is structurally underbuilt for this pace. Vistra, as the largest competitive power generator in the country, controls assets at the bottleneck of that constraint. Scarcity pricing in competitive power markets is a function of supply-demand balance, and AI is tilting that balance rapidly toward supply shortage.
The Meta PPA converts that macro tailwind into contracted revenue. Multi-year agreements with counterparties of Meta's credit quality are essentially utility-grade revenue, predictable, escalating, not exposed to weather or commodity price swings. Every additional PPA Vistra signs with a hyperscaler deepens that contracted revenue layer. Microsoft, Amazon, Google, and every major cloud provider is in the same build-out posture as Meta. The PPA pipeline is not a one-deal thesis. It is the opening of a multi-year procurement cycle that Vistra is uniquely positioned to serve.
Comanche Peak is the nuclear premium driver. Zero marginal cost, 24/7, carbon-free generation at gigawatt scale is the scarcest resource in the hyperscaler procurement market. Constellation Energy commands 35 times forward earnings for a pure nuclear fleet because tech companies with net zero commitments will pay a premium for nuclear-backed clean energy certificates. Vistra owns the same asset class in Texas. As VST's PPA revenue mix grows toward the contracted levels of a pure nuclear play, The valuation multiple gap to Constellation compresses.
Capital return completes the bull case. A $5 billion plus buyback authorization at price to free cash flow of 18 times with a growing contracted revenue book is a shareholder return engine. Free cash flow of $2.5 billion funds aggressive repurchases at current prices. Bulls argue AI power demand, nuclear premium, PPA visibility, and buyback-driven earnings growth makes VST one of the most asymmetric setups in the energy sector today.
Regulatory risk is the primary bear argument. ERCOT and PJM periodically revise capacity market rules, price caps, and ancillary service structures. Any rule change that compresses competitive power pricing hits Vistra's merchant revenue directly, with no regulated utility backstop.
Interest rate and leverage risk is the second bear vector. $12 billion in total debt, $600 million in annual interest expense. The Fitch upgrade helps at the margin, but balance sheet flexibility is limited. If rates stay elevated and power prices soften, earnings compress from both sides.
Third, merchant power price exposure. Most of Vistra's generation still sells at spot rates. Gas price spikes compress fleet margin. Solar additions in Texas push down daytime spot prices. PPAs remain a minority of total capacity. Until contracted revenue reaches 50% of the portfolio, VST carries material power market volatility in its earnings.
The primary watch point is the PPA pipeline. The Meta deal is proof of concept. If Vistra announces a second hyperscaler PPA in the next 2 quarters, the contracted revenue thesis transitions from a single data point to a confirmed trend. Market re-rating toward utility premium multiples requires a repeatable PPA business, not a one-off deal. Watch quarterly earnings calls for management commentary on pipeline volume, contracting timelines, and any named counterparties in advanced discussions.
Second watch point, Q2 power price realizations in ERCOT. The Texas summer is the annual earnings hinge. Vistra's 2026 consensus of $18.50 in EPS is built on assumptions about peak heat and the resulting power price and volume surge. If Q2 realized prices per megawatt hour come in below prior year levels, the back half model compresses and estimate cuts follow. Management's Q2 guidance will be the first read on whether the summer is tracking to consensus or disappointing. The financial profile: $4 billion in cash, $12 billion in total debt, $8 billion net debt against $2.5 billion in trailing 12-month free cash flow. Net debt to free cash flow at 3.2 times is elevated but serviceable for a generation business with growing contracted revenue. Operating cash flow of $1.2 billion in Q1 is seasonally light. The summer quarters will be materially higher. Fitch's upgrade supports continued capital market access. Annual interest expense of $600 million is the principal financial risk to monitor against power market conditions.
On valuation, the trailing PE of 50 times is a GAAP artifact from non-cash derivative mark-to-market charges embedded in the power hedging program. The economically meaningful multiple is priced to free cash flow at 18 times, competitive with infrastructure assets of similar contracted revenue quality. Forward PE of 22 times on the 1850 EPS consensus is a reasonable entry for a fleet that includes nuclear baseload, contracted PPA revenue, and a $5 billion buyback. The re-rating catalyst is PPA mix growth. As contracted revenue climbs above 40% of total, expect institutional reclassification from merchant generator to contracted energy infrastructure.
The options market priced a 7% post-earnings move for VST, elevated for a utility sector name, but consistent with VST's competitive market exposure and 1.15 beta. Put-call ratio of 0.78 reflects institutional bullish lean, with call open interest concentrated at the 150 and 165 strikes. The 165 call clustering is notable. It precisely matches the consensus analyst price target, suggesting institutional positioning for a mean reversion to analyst consensus rather than a speculative overshoot.
On insider activity, 2 executive open market purchases were reported in Q1 2026 at price levels in the 130 to 140 range. One scheduled 10b5-1 sale partially offset. Net insider posture is modestly positive. Management is adding personal exposure near current prices, which signals conviction on the AI power thesis at these levels. Chairman Curtis Morgan holds a substantial equity stake accumulated over Vistra's post-bankruptcy transformation, aligning his personal financial interest directly with the shareholder return program.
Institutional ownership has shifted meaningfully since the Meta PPA announcement. Technology infrastructure allocators, funds that traditionally invest in cloud and semiconductor infrastructure, are now competing with traditional utility sector funds for VST allocation. This broadens the investor base and adds a demand category that applies higher growth multiples than utility sector frameworks. As PPA revenue mix grows, expect continued institutional migration toward infrastructure tech classification, which should structurally compress VST's discount to Constellation Energy. 29 analysts cover Vistra. Consensus is buy, 8 strong buys, 14 buys, 6 holds, 1 sell. Average target 165, 14% upside from 145. Goldman upgraded to buy in March, Citi in February, both citing AI power demand. Barclays maintained overweight. The analyst community is broadly aligned on the structural thesis. The live debate is PPA timeline and whether summer power prices support the 1850 annual EPS model. This episode is for educational and entertainment purposes only. Nothing discussed constitutes financial advice or a recommendation to buy or sell any security. Charged alpha may hold positions in companies discussed. Always do your own research and consult a qualified financial professional before making any investment decisions. Past performance does not guarantee future results. Thank you for listening.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.